Hey everyone, welcome back to Corporate Decoder, the place where we decode complex financial reports and see if this company is making money or just making excuses. This quarter, CULP Inc. might be singing a sad song because their sales took a nosedive. Let's peel back the layers of their latest report and see what's really going on. Welcome to CULP Inc.'s quarterly report, their financial health check for the period ending August 3rd, 2025. Let's dive straight into the numbers. In the first quarter of 2026, CULP Inc. brought in about $50.7 million in net sales. That's a pretty big drop from the $56.5 million they made in the same period last year. That's a 10.3% decrease, meaning they lost almost a tenth of their sales in just 1 year. Despite lower sales, their gross profit actually went up. It jumped from $5.1 million to $7.2 million. This is a nice 42.4% increase. So even though they sold less, they managed to keep more of the money from each sale. This is a definite positive sign that they're either making their products more efficiently or they've managed to increase prices. Here's where it gets interesting. They booked a restructuring credit of $3.5 million. That's a huge swing from the $2.6 million restructuring expense they had last year. It looks like a big chunk of this credit is actually from selling off some property and equipment which brought in about $4 million. So while it's good news for the bottom line, it's important to remember this isn't from selling more. Because of that restructuring credit, their operating income turned positive, showing $1.6 million compared to last year's operating loss of $6.8 million. This is a massive 123.6% improvement. And finally, the net loss, they reported a net loss of just $231,000 this quarter. That's a massive improvement from the $7.3 million net loss they had in the same period last year. This is an almost 97% reduction in their losses. Let's break this down by their business segments. In their betting division, sales were pretty much flat, staying around $28 million. That might sound okay, but considering they had an extra week in their reporting period this year, it means their sales per week actually went down. The upholstery segment saw a much bigger hit. Sales dropped by 20.4% down to $22.6 million from $28.5 million. They blame this on a weak housing market and some tariff issues that messed with their orders for about 5 weeks. Despite falling sales, the betting segment's gross profit margin shot up from a negative 1.2% to a positive 10.5%. That's a huge turnaround, likely due to cost-cutting measures from their restructuring efforts. However, the upholstery segment's gross profit decreased. It went from $5.5 million down to $4.3 million, and their gross margin dipped slightly too. This segment is clearly feeling the pinch of lower sales. Looking at their balance sheet, accounts receivable, meaning money customers owe them, stood at $18.4 million. This is down from over $21 million last year, which makes sense with lower sales. But their inventory levels really jumped. They had $50.1 million in inventory this quarter, up from $41.7 million last year. They say this is because they're strategically sourcing materials with longer lead times and also facing rising costs and tariffs. It means they've got more cash tied up in products they haven't sold yet. On the debt side, their total lines of credit went from around $4 million last year to over $18 million this quarter. A big chunk of this is from new borrowings on their US and China credit lines, including supplier financing. This shows they're relying more on debt to manage their cash. It's also worth noting they had a significant amount of accelerated depreciation, which is basically an early write-off of asset value, especially for equipment. This was tied to their restructuring, meaning older equipment is being retired faster as they streamline operations. They also granted stock-based compensation to their executives, with performance-based units showing some complex calculations involving market volatility and peer company data. Time-based grants also contributed to their compensation expenses. And here's a tough one. They put a full valuation allowance against their US deferred tax assets, which are basically tax benefits they expect in the future. This means they don't think they'll be able to actually use these benefits because they've had significant losses in the US for the last few years and expect more. This is a major red flag about their US operations profitability. In terms of liquidity, their cash balance increased to $11.1 million, mainly from taking on more debt and selling some assets. But their net cash used in operations actually went up, which isn't a great sign. It seems they're using cash faster to run the business, partly because of that increased inventory. Selling, general and administrative expenses, or SG&A, went down slightly. This is good news as they cut costs here despite the sales drop, partly due to restructuring efforts. Interest expense did go up though from a very small amount to $183,000. This makes sense given their increased borrowing. Scroll of expenses, mostly from foreign currency fluctuations, also increased. This highlights the complexities of operating in multiple countries. Let's look at the betting segment again. While sales were flat, their gross profit turned around dramatically. This is a big win from their restructuring efforts, showing they can be profitable even with stagnant sales. This upholstery segment, however, is still struggling with sales drops and lower profits. They're hoping that combining operations will eventually help, but right now it's a drag on the company. Inventory turns for bedding slowed down significantly, from over 4 turns a year to less than 3. This means their inventory is sitting around longer, tying up more cash. Upholstery inventory turns were better, but also slowed a bit. So, what's the story here? CULP Inc. is clearly navigating a tough market, especially in upholstery. The bedding segment shows signs of life thanks to aggressive restructuring, but overall sales are still down. The big jump in inventory and reliance on debt are definite areas of concern. The fact that they need a full valuation allowance against their US tax assets suggests their domestic operations are really hurting. While the restructuring offers some hope for future efficiency, the company's direction feels like a survival game, trying to cut costs and manage a downturn rather than seizing growth opportunities. They need to convert that restructuring credit and cost cutting into sustainable, profitable sales growth, especially in the US. The upholstery segment needs a serious turnaround, and until that happens, CULP will likely remain in a challenging operating environment. Alright, that's our breakdown of CULP Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.